Episode 97. Great news all around. Inflation has been tamed. Just kidding. Political gridlock has been punted. Also kidding. And it is a bull run. The third zinger right here in the title. Well, a couple of quick things. Please remember that even a blind squirrel can find a nut once in a while. Don't believe me, do your own research. And if you are new to fixed income trading or to value investing, the best way to understand this show is to use the playlist called the Income Investing Roadmap. My usual disclaimers: this is not investment advice or tax advice, it's education. I am not a wealth management advisor and I am not sponsored. I don't endorse politics or product. Well, I'm going to start on a very different note. I'm going to talk about Tampa Bay. And to be clear, I have no gripes about Tampa or its sports teams. I do not bet on sports. In the next few minutes are an analysis of the Tampa Bay Buccaneers just to illustrate a point about economics and the Fed. So take it in jest and we'll see where it goes. So, football fans, I thought I would do you a favor. I started looking at Tampa Bay and I used this source called footballdb.com. And from what I understand, Miami Dolphins have the best record in terms of touchdowns. They have 38 touchdowns, and 36 out of the 37 times they get the point after the touchdown. That's incredible. And look at this, they don't even show up for a field goal a lot because they convert everything to touchdowns. Go Miami. In the meanwhile, the Tampa Bay Bucks are kind of sort of near the bottom of the table. They only have 18 touchdowns. They don't even have a rushing offense. That's very tough for them. And they do convert when they get their touchdowns. For a good part, they convert the point after the touchdown. But hey, their field goals are superb. When they show up for the field goal, they generally get it. So the key challenges, if I were looking at Tampa Bay and measuring their performance, I would say they got to get some touchdowns going. Their passing touchdowns are there. Their rush offense is really not there. But hey, on the bright side, they get the point after the touchdown, and they generally do well on field goals. And now I will assume the duties of the NFL commissioner and say, gee, I wonder if I can change the scoring rules. Just a couple of small tweaks because I want to help Tampa Bay. I'm going to make touchdowns worth only 1 point. Rushing touchdowns, who wants to see a rushing touchdown? They are not worth anything. The extra point after the touchdown is now going to be worth 20 points. After all, you got to keep your head very level after a touchdown. Field goals, I like field goals. Field goals are now worth 17 points. And also, if the humidity is high and the air is hot, then there is an extra stress point of 261 points on the scorecard. Now that I've made a couple of these simple tweaks, I introduce you to the new champion, Tampa Bay. Nice job, Tampa Bay. With the new rules, you win. Well, here's why I kind of use that extremely silly message. If you remember the episode about CPI, if you don't, you should watch the past episode. There are a few thousand people like you and I who report prices. And they say, I bought this kind of cheese, I bought milk, and so on. And that whole supply of data goes into a large system of economists and researchers who grind it, assign it various weights, and that system is with the Bureau of Labor Statistics. That's wonderful. So what did the Bureau of Labor Statistics do? They took a quick look at health insurance. And to give you an example of how health insurance works, the employee pays a premium. You pay for your family, or if you're single, you pay just for yourself, with kids, without kids. The employer pays another portion, and usually the employer portion is a pretty hefty portion. And the insurer collects the premium, and the insurer says, okay, now I'll have contracts with the providers. The employee has medical costs and they pay some out-of-pocket costs depending on their utilization. The insurance company pays claims to the provider when you and I, the employees, go to the doctor. And whatever the insurance company collects but does not pay is profit. Very, very simple. We all know this. Well, a couple of small tweaks, not like the Tampa Bay, but a couple of small tweaks. Let's look at an actual example. Let's say the employee pays $800 in premium instead of 720. Ouch, nice increase in premium. And the employer also pays a nice big amount, and their premium also went up. The insurer collects the 2600 plus the 800, nice. And the employee incurs some out-of-pocket costs because they completely, blew through their copay and they had to pay some out-of-pocket, and the out-of-pocket may be even higher, it doesn't matter. Conceptually, the employer paid 2% more this year than last year. The insurance company settles all of their claims, and they also had a little bit more expenditure this year than last year, and the rest is profit. And let's just say this is the hypothetical case, and I am going to say I only want to focus on the out-of-pocket because that is what the consumer is seeing. And so the consumer paid 200 instead of 196. Hey, can we just ignore the fact that I paid another 80 bucks in premium? It's just between friends. So as long as I only look at the out-of-pocket costs, it's not that bad. Inflation has actually fallen to 2%. And that is kind of sort of what BLS is now telling us. They are saying, look, here's what we're going to do. We are going to focus on the actual care with the doctor. The pesky prescription drug expense, that doesn't matter. We're going to give it a really low weighting. The amount you paid out of pocket with the doctor, that is very important. And also, when your premium went up, let's just not pay too much attention to that. We're not going to add a lot of weighting to the premium. Once you tweak that score, magic happens. Look at this. CPI has been falling, and the cost of medical services, amazing. It's actually deflationary because we are now paying less of our paycheck for health insurance for medical services. Incredible. I told you not to look at this other thing called commodities, which is going up. Keep your focus. Keep your focus. Look at this. Look at this. The cost of medical services has gone down. And before you get very, very upset that the formula is getting changed, before you start calling people names and saying, oh my God, this is terrible, let's not sit here and say everything around us is false. A few things to remember. Medical expense is still only 8% of the CPI. Even if there is a big body buried under there and there is a 10% increase in medical expense that you're not seeing, it's 10% of 8%, which is really a really small number. So at the end of the day, the effect on total inflation is not high, but hey, the rules did change. Well, the intent, however, if I try to defend the Bureau of Labor Statistics, I would sit here and say, look at what happened. During COVID, the insurer collected all this premium. You and I did not go to the doctor, and there was this huge increase in profit. And when COVID ended, everybody went to the doctor. So there is all this aberration. And so we need to smooth it out. And so I'm building trust here. We are going to do this operation here where we're going to roll time back to 2018 and just draw a smooth line. And so comparisons will be made to that smooth line and not the actuals, which are all over the place. And that is what the BLS explains. Hey, let me tell you why we changed things the way we changed it. We changed 5 things. We went to a different data carrier and we, excluded this and we included Medicare Advantage. And then instead of measuring every 6 months, we measured every 2 months. And once you do all of that, big news, look at this amazing, amazing thing. CPI is now showing that inflation is at 3.2%. It is better than what anybody predicted. And you just need to exclude 3 things. Exclude the effects of eating, which, restaurants, if you've been there lately, there is a restaurant fee, breathing fee, packing fee, fork fee, and also fuel. Gasoline costs are lower, but energy costs, go look at your electricity bill, tell me how it goes. Look at your heating bill, tell me how that goes. And also your health insurance premium. Look at your premium this year versus last year. Let me know how it is. As long as you avoid those 3 and you keep your focus on everything except that, hey, you know what? Apparently we are turning the corner. Well, there is another thing where we could turn the corner as well. We don't have the fear of a shutdown. So you put these 2 together. kumbaya, the market rejoices and the market says, oh my goodness, let's kick things up by 5%, 4%, 3%, incredibly huge bounces because allegedly inflation has been tamed, the Fed will not increase rates, and also political shutdown has been avoided. Well, that may be the market. This is Mr. Tavi Costa, and he pointed something out with the quote market. The top two companies in the S&P, Apple and Microsoft alone, have 14% of the weighting of the S&P. Four sectors: energy, real estate, utilities, and materials. So every energy company, every real estate company, every utility, and every mining materials company, all put together, have less of an impact on the economy than Apple and Microsoft together. You process that and you decide whether the S&P is a good indicator, whether we should put your money in an index fund, and hey, you do you. The bottom line is, if these two are doing well, the quote market is doing well. In the corollary, if there is a hiccup for either Microsoft or Apple, the index will also come down in a hurry. My thesis is the quote bull run in the market is completely ignoring reality in food, energy, and healthcare. Spending fights are real. If the government says we are not going to spend, those big two are big vendors to the government. You do the math. And so the key dates on spending fights are January 19th and February 2nd. I don't know what is going to happen. Cooperation does not seem to be the theme of how people are approaching each other. And so based on that, here are my trades. I buy treasuries. I mean, the things that mature, they mature. I buy treasuries that mature right around the dates where the two laddered CRs are coming up. I did buy Intel, but that is my fifth buy of Intel, and I'll explain why that is. There were a couple of days where everybody shunned energy, so I picked up some COD energy. I also picked up some CIX console energy, and these are all in my top 6 from the value superstars. Having said that, there is a rationale behind why I picked up Intel. This is Intel in the last year, and they've come up by a very meager 37.71%. I am not new to Intel. I've been buying Intel since June this year. The reason I don't talk about them is because they don't fit the traditional value criteria. Intel has barely been eking out a profit. If you look at their earnings, it's not stellar, but I have a thesis. My thesis is that as the relations between US and China with respect to semiconductors diverges more and more, Intel may look like a good guy to the US customers. And so I don't know. But if you look at Intel, they have not even reached their mark 5 years ago, and they are a leaner and meaner company. This is speculative. You do the math, you decide whether that is a good buy. Aside from that, there are a couple of other things that I've been noticing. Several of my FHLB callable bonds are being called. Anything over 5.5%, the 6.5%, 6%, I'm very sorry to say, are getting called. And that clearly is an indication that the agencies are saying, I don't think the Fed is going to increase rates. I'm just going to call the bonds and reissue them at a lower rate. So that's happening. My portfolio continues to have a slow dance over the last 6 months. It has appreciated by 3.7 something percent. Schwab had a little accounting error. When one of my bonds got called, they gave me the money, but they left my bond position in there. Thank you, Schwab. And 2 days later, my bond position was removed. So that's a very odd thing that happened there. But having said that, I still have 7% after tax. I'm very happy about it. And using the theme of the day, changing rules, if only you only counted the up days for me and you did not count the down days, my portfolio returns are 24.6%. Bureau of Badri statistics. Just kidding. All right, my 6-month strategy is pretty simple. I am still going to stay on T-bill and chill. My new target date for putting T-bills is February 2024. And I am unfortunately anticipating that collaboration will be a scant quantity. And if there is indeed a spending issue, then the two big companies will get hit. And if those get hit, the S&P will crash. And if the S&P crashes, everything else will crash. So I will just pull up my armchair and wait for that and see where it goes. If there are value buys, I will buy. Otherwise, T-bill and chill is still what I intend to do between now and February next year. Thank you, and feel free to send your questions and comments. Have a good day.